How do you actually know how long you should hold your property investment for? Hi, I'm Jared Krause, co-host of the Property Pals Australia podcast.
And I'm Sam, his other co-host that's with him every single week. And in this episode, it's part two, the discussion with Luke Metcalf, who's the founder of Microburbs and one of Australia's top property data scientists. Look, he's got over 3 decades of experience, and he's tracked markets, in Australia, the property market, all the way back to 1990, and formulated some really amazing models to help, decrease that risk for investors and also amplify returns. So, we discuss a fair bit of information in this part two of the podcast. We talk about median house pricing and how it's typically inaccurate. God, a bit like my speech. And how microburbs calculates and how with their smart median house price, it's actually more accurate. And then a few interesting things. Jared asked me, look, how I use the platform. And obviously, I think people are going to get a lot out of that in their own journey because I share with you the key data metrics that I look into as well.
Yeah, it's great to hear that from you, Sam, being a sophisticated buyer's agent. And I think Luke got a lot from it as well. Luke also shares how best to use the platform himself, not for himself, for investors, and owner-occupiers. We also discuss, why most investors actually acquire properties at the wrong time in the market cycle and how you can actually fix that. But before we get stuck in this pod, understand that we do have our How to Maximize Your Borrowing Capacity mini course. Get that at propertypals.au/resources. It's an awesome tool that can help you get a higher borrowing capacity to achieve a better ROI from buying a superior asset. Let's dive in.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
I guess from an investor point of view, is there a case for affordability being a key driver and yield for investment, for capital growth? Because I'm looking at these investors, right, and they're getting more and more, dominant in the space. I don't know, maybe it's just my Instagram feed just blowing up with, baristas to buyers agents, and it's making me go, well, they're all chasing a 5% plus yield. And those areas that are indicating that, tend to perform quite well. They boom in value. But then there's also the owner-occupier market, like that first home buyer that's quite buoyant. You mentioned, from a risk perspective too, as an investment advisor, you sit there and go, well, I look at, what's the worst case scenario, and how can we use property as an investment vehicle to protect your asset class, in those times. So I look for affordability for those reasons, but also, you mentioned cash flow is a massive component because that's how you hold these assets. So are they some key drivers, or what's your sort of feeling on what the research is saying?
I would tend towards cheaper properties. So they're more resilient. You want to buy a commodity, yeah? You don't want to buy something that is, unless you've got a particular view that a particular kind of home is going to appeal to a celebrity or something funny. Generally, your low-end properties show really good growth, and they're much more reliable to flip. So out of properties that have actually sold and resold, the average hold time is only 4.5 years. So you have to be, a reality is that you should be prepared to flip. Yield is usually a good thing. So the more yield, up to about the 95th percentile, yield and capital and subsequent capital growth are correlated. So in general, there's not a trade-off. It's just at that very top end that you've got these real standout ones, the undersupplied towns going through some industrial boom, the positive cash flow kind of stuff. It's only at the extreme end of yield where you are seeing low capital growth.
Yeah. Can you put some parameters around that? I mean, pricing, like below 750 grand would be the target, or like yields above 4.5%, 5%. Do you have much information around that?
It does depend on particular markets. So so if you compare like high end metros, Sydney and Melbourne versus cheaper ones, Adelaide, Hobart. So there is nuance there, but broadly speaking, there's more upside on the low end. I would tend towards your cheap properties with good yield. Yeah. So, and by low end, I'm talking pretty low. So coming back to that gentrification discussion before, it's like dynamism and vitality. Yeah. So it doesn't have to be. You don't want highly educated people in general, but you just don't want it to be, a suburb that might end up becoming notorious for the wrong reasons. Yeah. So it finds itself on the news, or just locals know it's a real dump. I would tend towards, there's a lot of metrics that are, it's actually not that you should go for extreme end or the other. Yield is an example, but you should go for the middle. So it's a mama bear, it's a Goldilocks kind of thing. Yeah. You want to be just right. And, your affluence score, for example, you don't want it to be very low and you don't want it to be very high. But with yield, it tends towards the more yield, the better, up until that top fifth percentile. I can't tell you the exact number off the top of my head because I'm always looking all the way back through history. So most people in the real estate industry are very focused on right now. They're very focused on what stories to tell. But I'm always just like, how universal is this pattern? Because like, you shouldn't rely on me as like the trend arbiter. Everything's like in flux. What's really stable? What's the stable ground? I don't go on the sand. Stand on the rock. Yeah.
No, that makes sense because if you go into sort of the Sydney market, a good yield would be 4%. But if you go to say the regional Queensland market, 4% is a bit of a rubbish yield. So I get what you're going at, and then it's median prices is somewhat of a reflection too. So it's kind of following that sweet spot, Goldilocks zone, whatever you want to coin it.
Yeah, within markets, it's a good question. Within markets, you go low, or do you just go for the cheapest markets? Broadly speaking, I think it's both. So yeah, you can look at it from the context of the the market that you're looking at. If they have to live in Sydney, what are they prepared to do? The reality is, at the bottom end of the market, there's always people who are prepared to get in. So whether it be people transitioning from renting to buying, people who have hit hard times, people who are downsizing, people who want to move closer to town, there's a trade-off. But at the high end of the market, you can have it really fall off, particularly as you get very high. Yeah. So, you have a GFC or something, and you can have a whole lot of foreign people go elsewhere or something.
Yeah, and that would be the lead to those capital markets during those more troublesome economic times. They underperform compared to other, I guess, regional markets, would you say? Or I think we talked about this in the last pod where I guess the buoyancy of those regional markets can be less of a downturn than those capital markets. Is that sort of in line with what you were mentioning?
That's an interesting one. So I focus less on individual events like one recession or one GFC. Even though I know it's very big in people's minds, they'll be thinking, what happens if there is high interest rates or if there's a recession? My focus is more on learn more from things that have happened many times in the past. So I don't want to just say this is the world of this is what happens when you have a pandemic or you have a GFC. I'm more like, well, regardless of what black swans get thrown at you, what are the things that are most resilient? We don't know what kinds of, maybe we'll have a different kind of pandemic next time. Maybe it'll be a digestive system virus or something. And I don't know. It's just looking, yeah, so often there can be this disjoint, like I can't always connect with what people are talking about now because I'm not as clued into how everyone's thinking about it now. I've just got this longer term view. I guess it's a little bit more like being a historian than being a pundit.
I like where your head's at, and Jared will probably jump into this. Is like the history never repeats, but it rhymes. But if you're constantly in that fear of what if this happens, then you'll do nothing, and that's worse than doing something in regards to your investing. And I mean, you zoom out. We've gone through that many different financial, I guess, crises, recessions, depressions, and the prices of property is higher today than it's ever been. So it's like,
there's a long history of bears. So it's one thing to say the property market's going to go down, but the history of the bears actually saying it for particular times, it's been a bloodbath for them.
And so do you look at, I think you said since 1990, do you look at the data of each of those, I would say, how do I classify this, somewhat catastrophic events globally, nationally, to the markets, and then look at like a median on how much they were affected between those versus just one singular one?
What I do is I just focus on relative growth and so I'm like, I don't know where the overall property market is going to go. This is in the market forecasting in particular. So most of the time it's all about relative growth. So there is some kind of overall market performance that you're going to get, and that I don't know the answer to that. You could defer to a macroeconomist on something like that. So the models are kind of, to a fair degree, they're insulated from it. So microburbs is all about you pick the right suburb, you pick the right street, you pick the right property. So it's at that point where it's like, okay, and hopefully it is, even if you see macroeconomic headwinds, if you can make enough money when you buy, and you've got a place with solid capital growth, it should be able to more than offset those economic headwinds. So I'm more in that space. It's more reliable to do that. So it's a little bit like, there is a law of physics that if you drop a ball, it's going to go down at 9.8 meters per second. And I'm not worried about, whether the neighbor's going to jump in and kick the ball away, or, if there's going to be a cyclone, generally speaking, it's going to go down at that 9.8 meters per second. That's always the goal, is to be as scientific and universal as possible. So if I was just trying to predict overall capital growth, I mean, it would be kind of warped in lots of ways, and you don't want the model to get too fixated. You don't want it to start thinking, oh, I think it's 2019 now, so this feels like 2019. It gets a bit arbitrary, right? It could overfit to those circumstances and start to come up with dodgy macro theories, effectively, that can't be proven over time.
Could cause it to become more inaccurate, right?
Yeah, so it's like it's in a way it's in a sandbox where it's like, okay, there's a whole lot of suburbs, and the underlying assumption is they're not properly priced. Yeah, there's opportunities. They're too high or they're too low, and given within that world, where are they relative to one another? That's the forecasting model side of things. And then on the broader term gentrification kind of things, again, we're forecasting relative growth. So it may be, so the whole Australian market might have gone up a lot over 3 years since a particular, metric came out from the government. But still, it's like you can't take the credit for a particular kind of suburb going up a lot if it didn't outperform the rest of the market. Yeah, what's special about it compared to other places? Whereas you see a lot of people in the industry talking about all this awesome growth that happened, and it's like, yeah, but so what? Like, it was, most of the market performs pretty averagely most of the time. Yeah, so if you focus too much on a particular time frame, then you're going to be much more about what's happening in the macro. What really matters is when you're coming to a suburb selection phase, what really matters is the relative merits of one suburb versus another. So that's the reason I like to have quite a separation of those things. Don't make your story too complicated. Like if there are too many ifs and buts and whys, then you're getting further away from science and you're getting more into the realm of just storytelling. So I'm trying to a degree, tell stories, but it's like my goal isn't just to capture your imagination and have you, oh yes, that's such a beautiful place. We had a beautiful cup of tea there, and it's much more, this is just
Data backed.
A law. Yeah. So yeah, it's data backed, and it's like as much as possible a law of the market rather than a trend. That's what I'm really always trying to divine.
I love it. You mentioned about the 3-year growth rates, and what's your viewpoint on that? Like, the last 3 years have been quite. The Australian property market since the lockdowns it's been performing really, really well, well above, I guess, averages. People look at areas and they say, "Oh, well, that's grown X% in the last 3 years. Surely it can't, continue to grow." Is there a certain metric around those 3 years that you look for? Like saying it hasn't grown more than 100% in the last 3 years, you wouldn't invest in there. Like, do you have any information around that?
Yeah. So everything's contextual. Yeah. So everything's supply and demand. So it's relative. So one aspect is just the shape of the curve itself. So you can learn from that universally. And then there is all this stuff to do with how it performs relative to other stuff. And it's actually quite complicated. So if you simply try and provide simple rules, so I have tried plugging in like very simple rules, this tick box kind of way of doing it. If it is over this price and if it has grown by this much, therefore you should buy. Those simple things don't actually work over time. So you can't, it's not like there's some basic rule that you could have applied since 1990 and make money. The markets are too intricate. There's too much going on for you to do that. So I don't have any exacts there beyond to say, broadly speaking, I personally like the cheap end of the market. So in terms of like people saying after COVID, well, prices have gone up a lot and there's all this, affordability stuff. Obviously, everything comes down to supply and demand, and huge, unprecedented numbers of migrants coming in. They have to transition. They want to transition from renting to buying over several years. So, you can come up with all kinds of macro stories. So one is like looking at, look, it's been a long-term momentum, or you could say, look, affordability's out of control now and something has to correct. I just look at the history of the bears naming it for particular times, and they haven't done well. And so, and I've focused my own forecasting, like not that particularly on the market timing, technical trading side of things. That's very much over a 2 to 4 year period. So I'm less worried about that kind of thing.
No, I think it's a smart way to be. I've said it on a previous podcast. We've got a mentor coach that they have, like they're a fund manager over in Switzerland, and they've come out to say, look, it's really challenging to forecast anything like from a global, like a macro position, over 6 months because so many unknowns. And I mean, what's little old me going to know compared to people that study and analyze those markets every day? I like that viewpoint that you got where you're zooming out and just going, well, who cares? Let's get rid of the noise. Let's focus on, the historical trends. And
there's an analogy here to the weather, So if you ask any meteorologist, I've spoken to 3 or 4 of them. Whenever someone's a meteorologist, I ask them, please confirm this for me. And they will all tell you, they will all admit, and often very readily, that they really don't know what the weather's going to be in 7 days' time. So you have these long-term forecasts. Look it up. They just say, look, it's too complex a system. We can't know, a day or two. Yeah. We can forecast within a certain degree of reliability. And so, but people will, like, I'll have a friend. I'll say, hey, look, let's meet for a picnic on Saturday, and it's Monday. And they say, oh no, the weather's looking better on Sunday. Can we make it then? It's like, No, there's no difference. As a meteorologist will tell you, after that period, just look to like the averages for that part of the world for that time of year, or maybe whether it's a El Nino or a La Nina or something. Yeah, they just don't know. And it's amazing that it's all over the media, these long-term forecasts, and people are incredibly forgiving of the fact that it gets it wrong. So it's like people get asked, why, yeah. So analysts, there's a classic saying, analysts forecast the future not because they know, but because they're asked.
Yes. Well, you need to. I mean, going into analytics, it's a good segue into how many data points does microverbs actually pull into to get the analytic forecasts?
I have, so one part of it is the deep scan. So there's actually billions and billions of data points that go in, and then most of it gets thrown away. Although increasingly with the AI, as the AI gets more sophisticated, the roadmap is to be able to take in more subtle hints. Yeah, so there are billions and billions of stuff that gets fed in, and just there's a small amount of stuff that rises to the top that says that, where you can say, yeah, this is actually a useful indicator that we can put on our site. We can talk about. There's a whole lot of other stuff that's like, yeah, it over the macro looks really good, but then you break it down by capital city, and it doesn't work within the capital cities. Or it was like, yeah, much of this was simply the fact that Adelaide was going up a lot at that time. So it's like, if you control for enough factors, then a lot of this stuff just goes away. You can easily come up with a persuasive argument for it. But yeah, but having said that, we don't pretend to know everything. So we're also in the game of we'll provide you the data that you want to go into. Maybe you might know something about a particular metric that we don't, and it could well work for you in particular markets. So my approach is always like, what works across, what's as universally applicable as possible. But maybe you know something like, for example, absolutely, the mining industry affects WA. Yeah. So if mining is going well, then, and maybe there's something about orders coming in from China, and there'll be all kinds of these more micro things. And for that reason, we have, to answer your question about how much have we got, we've got this expert mode on microverbs where we call it the Data Explorer, where you've got 5,000 different metrics that you can look at. And with that, you mouse over, you get to see it in a beautiful heat map for the whole city. You get time series graphs. So for those people that are really focused on particular metrics, maybe the metrics are used in order to make the deal happen, or maybe they're really powerful of their own. So we've got all of this backing for other kinds of analysts and other approaches. So I definitely take seriously also that we are this data platform that can be used for all kinds of stuff. So yeah, billions and billions of data points are available to us, and 5,000 indicators that go across most of the country. We're in the business also of working out what it would be if the government. So, for example, if one state has provided data and the rest of the country hasn't, sometimes we'll go in and actually infer what it would be. So, using machine learning to fill in the gaps, so to speak. And so it's very, very broad. We take very much a big data AI approach as opposed to a more like spreadsheet and dashboardy kind of approach on the back end. But on the front end, like with our suburb reports, it's very much like we've learned a lot by talking to investors. These are the things that are the most important, that are the easiest to get your head around, and but still give you an edge. These are things that you can't get elsewhere for that particular use case of, hey, I want capital growth for a suburb anywhere in the country.
I love that, Luke. And I have a question for you, Sam, as a user of microverbs. Might be valuable for you, Luke, to see some use cases and how it's being used, especially by somebody as sophisticated as Sam in the space. Sam, what are some of the key metrics that you have looked at that you like, that you would probably like to be using more moving forwards for helping clients acquire properties for capital growth. Is there maybe a top 2 to 5 that you like since being a user of microburbs that you think would be good to give Luke kudos to, and then also the other users wanting to use microburbs, why you're looking at those metrics and why you think they're quite good?
Yeah, well, I'm just always looking for ways to outperform, but I'm also mindful of coming through in this space and seeing buying in different locations, and then somewhat concerned about people all looking at the data points, and these large investment buyers agencies that are just flooding into markets and creating somewhat of a bubble, which is kind of why I've always been sort of following microburbs and now a user of it, just to obtain those high level data points that I don't know anyone else that actually does that level of, I guess, injection into their models. So I guess you sort of hit on a question too, Jared, of what I was going to ask Luke, because how's the best to use it. But the way I go about it initially is trying to find those suburbs that are looking to outperform. And I love that smart median house price index. So obviously, if I'm looking into certain states for different clients, obviously looking at portfolios, balancing them out is important, and then knowing what it is they're trying to chase. So starting from a strategy point of view, and then once we have that, borrowing capacity, what their cash flow requirements are, and understanding their portfolio and their risk tolerance, it then allows me to go, all right, well, we're focusing on these types of areas, like states, and then I use the microburbs platform to go through and go, well, if we're targeting, say, like a metro Queensland, like Southeast Queensland would be that pocket. It's the smart median house price is the first place that I start, and then I look at all the different other data metrics. So obviously, as an investor, everyone loves that forecast, that annualized growth forecast for the next 4 years, which puts it on an annual basis. It gives you that confidence because it's pulling all those data points to say, well, these suburbs within these areas are looking to outperform the most. There's still a large number of suburbs, and that's what I love about going deeper into the data through just that analytical tool, is to go, well, what has the last 3 years of growth been? What's the stock on market levels? And then like the inventory levels too are another key indicator that I like to play around with, because if you've got too much inventory, then obviously that's an indicator of higher supply levels. So we try to play with those models that Luke's built out, which is actually really simple. It's like a nice sliding platform that they use. Days on market as another sort of data point to go, well, how tight is this market held, and then understanding the trends that are involved in that. I go all the way down like this. The vacancy rate for me is somewhat of a forward-looking indicator as well, to say, well, if the vacancy rate's quite tight, below that, 3%'s always been that target, but with the way the market is now, below 2% is a strong market. I like to look at those because that's helping the investors go, well, obviously once they buy a property, you want to get a tenant in there straight away to get that cash flow going for them. You don't want it to be on the market for too long, so vacancy rate's important. But then I like helping educate people around like the lifestyle scores that you've got there. People don't really understand the complexities of the HIP scores, hence why my questions before. But public housing is a good one too. I think we've touched on this in the past with Luke, another podcast. Like public housing is, obviously you don't want too much public housing in your area, in my opinion anyway. But it's not the be all and end all. And I say this to a lot of people is, don't look at one metric, look at the whole picture. So I like to sort of focus on areas of public housing, around 15% or less, just to help that. But I remember one of Luke's mates, Jeremy Shefford, mentioning that, in order to offset, if you feel that risk, reduce your asking rent by, $20 a week, because you're going to get an increased level of, renters' demand, and then you can pick and choose the type of tenancy you put forward, because you can still buy in areas that have higher public housing, but it's the person renting that individual house at the end of the day that you want to try and avoid giving you too much grief. I go further down to it and to go, like, the gentrification thing for me is really important, because that's that, I guess, the long-term affluence type of level that I like to focus in for investors, because we want that strong owner-occupier appeal with a decent family score, and once again, that affluence score as well. So that's the filtering side of it, and that helps to depict the top suburbs once I'm rating it from the annualized growth from highest to lowest. And then you go into, then you've got your handful of suburbs to then go into the individual suburb reports that Luke's got even more data points about, to pick and choose those streets that are looking to outperform within that suburb, because he's done a really great mapping tool of showing that, like, there's quadrants within the suburbs, and no one else does this, right? Like, it's just a suburb base, but the quadrants can show, well, that part of that suburb is actually, it might be, say, have high public housing levels, but if you're looking to choose two properties that you want to buy within that suburb, I'd be leaning towards the one that has less public housing as an example, and higher sort of affluence scores, because that would be the more desirable pocket within that suburb. People that live in their own suburb know that there's certain areas that you'd rather live in, like, say, Burley Waters as an example. It's one suburb, but there's the Bermuda Street that runs through the middle of it, and on either side you see a large discrepancy of house prices. So that's how I use the data, Luke. But I'd love to get your opinion on how to best, I guess, utilize this asset you've built out. And
so you've named a whole lot of important stuff. You're a sophisticated BA that's doing the hard yards and not just picking out a couple of things that sound good. You're generally doing the analysis. And there's so many things there where it's like each of them might influence capital growth. Like I'll have it by a couple of percentage points, but that's annualized. So over a long period of time, they each have a highly significant influence on where that value is going to be after 4 years. So as you're describing, using that suburb finder tool, there's like 20 different indicators where you can choose the ranges for, as you were describing there with the slider, to find the best. So there's like all these things, like land supply is another one. So that's factored into our forecasting model. And when there's 20% or more land release within 7 kilometers, there's 3% less growth. But it's particularly the case in regional. It's not so much about in the capital cities where there's a lot more choice. It's a much bigger market. It's a perfectly valid approach, because each of these things do have an influence, but there are many things going on. You could boil it down to, like, it's just how many buyers are going to come in. Are they going to? The more different kinds of buyers, the fewer things that are going to turn them off, the more likely they are going to compete and bid up the price later. So if one buyer might be turned off by public housing, another buyer might be turned off by the lack of industry in the area. That's particularly if you're selling to an investor who's like, it's just one of many things. So all of these things feed into what the price is going to be. So if you're thinking forward to, the reality is people don't hold investment properties as long as everyone makes out, and you should be thinking about what are all the things that might turn off the person who's subsequently going to buy your property. So in terms of how to use it, capital growth, affluence score, tightly held streets, the supply, and all those things that you mentioned, days on market. There's levels of like widely accepted metrics like days on market and vacancy rates and things. And then there's specific things that have come out in my research that others don't have. So it's data platform, independent research leads to both conventional metrics and unique metrics that will give you the edge. And then even some of those conventional metrics like median prices, we redo so that we can make it far more focused on, can you actually get the can you actually sell that particular property for a high capital growth given what that property is?
Yeah, I go a little bit further and say, because there are so many things to sort of tick and check, I'd start with the least amount possible, and then start to filter through those types of suburbs using sometimes I don't do the days on market because I just don't want that added complexity. Because then sometimes it comes out going, there's only 2 suburbs that are within that whole region or city, and it's like, well, that doesn't really make sense. So that's how I kind of go about it. And it just helps give a lot of confidence to, I guess, the service.
So you can specify all the ranges of stuff. You can say, I want this much capital growth. I want this much yield. So you can use it just like you're saying. You could just trim outliers. You can say, look, I don't want. I think this metric's kind of important, but not massively. But I don't trust it if it's really at the extremes. So you can just put in as sophisticated criteria as you want, and the interface is designed so that every time you change the criteria, it updates the list of suburbs on the right. So it's like a live spreadsheet. And you widen it again, those suburbs will reappear, and you can sort by any metric. So, for example, you say, look, I've got 5 criteria that I'm after, but then I just want to sort by capital growth, and then I'll run through. So you can click sort like a spreadsheet. So, yeah, we get a lot of feedback that it's a quite easy to use tool for narrowing down, really at that suburb selection narrowing down phase.
Yeah, amazing. I just want to say that we've talked so much about microburbs, guys. Just go to anywhere in the description for this and get the link and suss it out, check it out, and see if it's right for you. There's so many awesome things. Also, Luke, you came on and we chatted. We split that episode up into 2 episodes, episode 60 and 61, on basically property data laws that lead to growth signals within Australia. Guys, if you haven't listened to that one, definitely check that out. It's dense. As is this one. Before we wrap up, Luke, is there anything that you would like to share with the audience that you've learned along your property data journey that would be valuable for them to know?
Anything, any extra little bit? I mean, broadly speaking, I would say investors are too into momentum. So you see that investor numbers drop off when markets go down. And this is a big part of the reason why investors actually underperform owner-occupiers. So there's a crazy stat that owner-occupiers actually do better. So they're too much focused on the fear of missing out when prices are getting dearer. So at the end of your property journey, once you actually buy the property, is more expensive than when you start. Wouldn't you rather have it the other way, where it's cheaper at the end and you get more power? And so it's an amazing thing that 1.5% per annum investors underperform owner-occupiers. I've tried as hard as possible to account for the fact that owner-occupiers are more likely to renovate. But maybe there's a bit of that still left in there. But there's some really big biases that humans have. We all have them. And you need to be, broadly speaking, as an approach, much more thoughtful. Get a BA like Sam Powell, who will be much more technical about it, much more scientific. Subscribe to microburbs, and don't just go on the emotion. These things, these markets do obey to a fair degree laws, and it's the way that we're evolved, the way that we think is not really designed. There's no point in our evolution where people were trading on markets until like a few hundred years ago. So I would be very careful to be aware of your biases and take as scientific approach as possible.
You're delving into the world of trader psychology.
Mm. Yeah. It's a lot of loss aversion. So people will only sell you can see it in the data. People will sell once they feel that they get their money back, for example. And
I can see it in the real world. I see markets that have done nothing for 10 years, and then we're buying properties off investors, and part of me is just like, oh, well, it's a shame that they've had such a negative experience. Like WA went backwards, did nothing 10 years, and then is now boomed. Buying property back then 3 years ago in WA, and then Gladstone as an example that was hit pretty hard, is doing quite well now, and I mean, there's opportunistic. It's hard, right? Like there's that moral ground where you want to tell the person, "Hey, don't sell it," but then that's my job is to get returns for investors. So it's
you have to take a step back. You have to. This is serious. You're competing against a whole lot of other people, and it's a complex business, and you need to distill down what are the things that truly work over time versus things that make a good story that just sound good.
I love
sound advice there, mate. There's the wisdom in the years.
Absolutely.
I've been doing this for 10 years, which is sizable, and been doing data science for longer than that. But there's wisdom. There's even greater wisdom in the years before I started, going back to 1990, and all of the data points. A lot of this government data coming out 2000, 2005, 2010 sort of time. So there's even greater wisdom in the years where the data was collected, much greater than any individual like myself analyzing it.
I love that. Guys, go tap into this wisdom, that data that Luke's been talking about at Microburbs. There'll be a link in the description. Luke, thank you so much for coming on. This is an insanely good episode. I'm just super grateful.
Thank you very much. It was always great to talk to you guys. I really appreciate the chance to offload all the stuff that's in my head.
We love it. Bring it on. Thank you.
Cheers.
All right, everybody that's listening, thank you for listening. If you hadn't hit the subscribe button, do so. And we'll see you on the next one.
Bye for now.